Individual annuity premium sales posted a solid year in 2024 on the heels of strong momentum in 2023. That according to a just released special report from AM Best. I'm John Weber for AM Best TV. Here to tell us more are AM Best Associate Director Jason Hopper and Industry Research Analyst Kaitlin Piasecki. And Kaitlin, surrenders increased again in 2024. What's driving that and how is the industry responding?
So higher interest rates and policyholders' desire for better performing products have led to the uptick in surrenders. When interest rates rise, it may make more sense for some policyholders to surrender their current policy and then purchase a new one that's going to be offering a better rate and terms. When these consumers move into a new contract, they're going to restart their surrender charge protection period, and that's going to help these companies lock in that business. Now, as a result, the industry now has nearly half of its individual annuity reserves within that surrender charge protection, and nearly 12% can't be surrendered at all.
Now, variable annuities had a nice jump in 2024. What's driving that?
So registered linked annuities, which we also refer to as RILAs, they're a newer type of variable annuity, gaining a lot of popularity in recent years, and that's really what's fueling the variable annuity sales for 2024. RILAs, they're riskier than a fixed indexed annuity, but they're less risky than a traditional variable annuity. They're tied to a market index, but they offer higher caps, and they also have downside protection through floors and buffers. We're probably going to see more growth in this product line in 2025 just because of the volatile financial markets and the unpredictable interest rates.
Jason, private equity and asset manager-owned life insurance now represents a third of industry gross premium, but more than half of seated reserves. What are we seeing there?
Sure. So with the heightened interest rates over the last few years, right, that drove demand for annuity products, a lot of growth. So one way to kind of manage this growth from a capital perspective is through the use of reinsurance. And in particular, private equity or asset manager sponsored insurers have been using subsidiaries in Bermuda or the Caymans, somewhere offshore, and they have been transferring a decent amount of their business to these offshore entities in order to manage capital at the operating companies in the United States. Private equity asset managers, as you mentioned, do make up the bulk of reinsurance ceded offshore, particularly to affiliated companies.
Is this having an impact on risk-based capital?
Yeah, so over the last few years, risk-based capital for our individual annuity composite has been relatively range-bound. But when you peel back that layer and look specifically at these private equity asset manager-sponsored companies, you do see a decline in RBC over the last 2 or 3 years or so. Along with that, these sorts of companies have lower assessments for quality of assets, BCAR volatility, as well as reinsurance dependence. Overall balance sheet strength is still strong for the individual annuity composite, but we have seen some deterioration over the last few years.
Thanks, Jason. Kaitlin?
Thanks, John.
Thanks, John.
That was AM Best Associate Director Jason Hopper and Industry Research Analyst Kaitlin Piasecki. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.